The Life Lesson of Harry and the Casino, a tale of discipline and self-control. Harry, a legendary American shipping magnate, once shared an unexpected life lesson with his son, Harry Jr. He promised that when Harry Jr. turned 23, he would entrust him with the financial reins of their billion-dollar company. But on Harry Jr.'s 23rd birthday, instead of heading to the office, the elder Harry led his son to a casino. Handing him $2,000, he said, "Use this to learn how to manage risk and control your decisions. No matter what happens, keep $500 in reserve." Harry Jr., eager to please, vowed to follow his father's advice. But in the heat of the games, he forgot. Driven by the thrill, he lost everything. Disappointed, Harry Jr. confessed, "I thought I could win it back in those last 2 rounds when my hand improved, but I lost even more." His father replied, "You'll return to the casino, but this time, no help from me. You must earn the money yourself." Harry Jr. worked hard for a month, saving $700. On his second attempt, he set a strict rule: stop playing if he lost half his money. Yet when that moment came, temptation won. Ignoring his limit, he gambled everything away again. Frustrated, he told his father, "I'm done. My personality just isn't cut out for this. I'm a failure." But his father was resolute. Life, like the casino, is a fierce competition. You can't quit. Go back and try again. 6 months later, Harry Jr. returned to the casino with newfound determination. This time, he remained calm and disciplined. When his losses hit 50%, he left the table. For the first time, he felt victorious, not because he won money, but because he conquered his impulses. Seeing his son's growth, the elder Harry said, "The true battle isn't against others, it's against yourself. Only by mastering self-control can you achieve real success." From then on, Harry Jr. played by his limits. Whether up or down by 10%, he always walked away. This principle not only preserved his bankroll, but began earning him steady profits. However, during one session, intoxicated by a streak of wins, he ignored his father's advice to quit. His fortune quickly reversed, and he lost it all. Sweating and devastated, he finally understood the importance of discipline. "If only I'd left earlier, I'd have been the winner," he lamented. A year later, Harry Jr. became a master of restraint. No matter the stakes, he adhered to his 10% rule. His father, moved by his transformation, handed over control of the company. "Business," he said, "isn't about knowing every detail. It's about mastering your emotions and desires. That's the real key to success." Harry Sr.'s philosophy, "The one who can walk away while winning is the true winner," guided their empire. The stock market parallel: simplicity and self-control. Harry Sr.'s lesson parallels the stock market. Markets reflect the collective emotions and actions of countless traders. No complex model guarantees success. Emotions often dominate the outcomes. Overcomplicating strategies can lead to failure, yet many traders fall into this trap, believing complexity ensures safety. In truth, mastering the market is less about predicting its every move and more about controlling one's impulses. Many traders overthink, adding unnecessary layers to their strategies, when often simplicity and discipline yield the best results. Like Harry Jr.'s journey, the stock market rewards those who learn restraint. Whether in gambling or trading, the ability to step away at the right time is the hallmark of a true winner. The reality of risk and reward in trading. In the stock market, risk and reward are two sides of the same coin. Trying to eliminate risk completely often means sacrificing potential profits. The so-called risk-free trading strategies or success formulas are usually worthless. Before diving into advanced trading methods, it's crucial to remember that every strategy has its limits, and no path guarantees absolute success. If you want to stay informed about money matters and achieve financial freedom, don't forget to follow this channel. Let's explore the essential elements of trading success: strategy and risk management, the chaos of the market, and the role of emotions. In the unpredictable world of trading, markets are inherently chaotic. This is a fact. Traders can't change the chaos. They can only adapt to it. However, adapting means constantly reevaluating subjective judgments, which are often influenced by emotions. When the market moves, so do traders' emotions, creating reactions that can either align with or clash against the trend. One famous saying captures this truth: the best simulator will never outperform the worst real trader. Predictions alone don't yield profits or losses. Only real trades do. Among the most damaging emotions in trading, greed and fear reign supreme. These two extremes, driven by bull markets, greed, and bear markets, fear, shape traders' decisions. For example, fear during sharp declines can paralyze even the most rational adults, while greed in surging markets can turn cautious traders into reckless gamblers. This emotional roller coaster often leads traders to follow the crowd. But in speculative markets, consensus rarely leads to success. The illusion of expertise and the importance of adaptation. In fields like engineering or medicine, following majority opinions often leads to correct results. But in trading, it's different. Market movements, influenced by collective panic, often defy traditional logic. Even highly accomplished individuals in other professions fail in trading because they trust too much in their personal expertise. Fundamental and technical analyses provide reassurance, offering seemingly logical explanations for sudden shifts. But traders cannot expect these tools to predict every twist. The only constant in the market is its unpredictability. This means that trading requires a unique mindset, one of self-awareness and emotional control, and a willingness to forge your own path. The journey of self-mastery in trading in many ways is a solitary journey. Other people's methods may inspire, but they rarely apply fully to your situation. To succeed, traders must build their own systems by honing their emotional control and refining their trading philosophy. Experienced traders often emphasize principles rather than techniques. To outsiders, these principles might seem unrelated, but they highlight the deeper truth. Trading is a form of discipline, akin to a spiritual practice. Success comes from internalizing core beliefs and staying consistent. Here are 3 key principles for stock market success. 1. Personal mastery is paramount. Your success doesn't depend on others' approval or agreement. 2. Develop a solid, well-grounded investment philosophy. Without a clear approach, you'll be swayed by market noise. 3. Invest only in companies you fully understand. Never rely solely on others' opinions. Before buying a stock, take the time to research the company thoroughly. Understanding its financial health can save you from costly mistakes. Blindly following tips or chasing hyped stocks often leads to disaster. Identifying long-term investment opportunities. Once you've conducted thorough research, allow time for your ideas to mature. Avoid the temptation to act impulsively on exciting investment tips. A rushed decision can lead to regrets, while a calm, rational approach often reveals flaws in what initially seemed like a great opportunity. Look for companies with strong competitive advantages. These are the firms that can fend off rivals and maintain above-average profits over time. Most companies face shrinking profit margins as competition heats up, but those with durable advantages can sustain superior performance for years. These are the gems worth holding for the long term. The importance of margin of safety in stock investing. The longer a company can sustain an above-average profit margin, the higher the long-term investment performance in its stock. However, always ensure there's a margin of safety. If you pay too high a price for a stock, your investment returns might end up disappointing you. The goal for any investor should be to buy stocks at a price below their intrinsic value. Unfortunately, people often overestimate the value of stocks, which increases potential risks in the future. The best way to counteract this bias is to only trade when a stock is priced significantly below its estimated value. For companies with uncertain prospects, a larger margin of safety is necessary. For stable companies with predictable earnings, a smaller margin is acceptable. For example, a 20% margin is reasonable for stable companies, but for more volatile ones, consider a larger margin to protect your investment. Many investors worry about missing out on opportunities if they don't buy a stock immediately. While it's true that opportunities might slip away, it's also possible that a company will face unexpected financial difficulties, causing its stock price to drop sharply. The future is always uncertain, but with patience, most stocks will eventually trade at a discount to their fair value. Evaluating stocks. The role of price-to-earnings ratio, PE. A simple way to evaluate a stock is by examining its price-to-earnings ratio, PE. This ratio shows how much you're paying for each dollar of earnings. By looking at historical PE ratios over 10 years or more, you can determine whether today's stock price is reasonable. You need to believe that the company's future prospects will far exceed the past decade. Sometimes, if a company's valuation is unusually high compared to its history, it's a red flag. The market may be overestimating its growth potential, and you could be looking at a stock that underperforms for years to come. Long-term investing and buy-and-hold strategies reduce transaction costs and help you weather short-term fluctuations. However, you should always know when to sell and continuously monitor the companies you've invested in. Instead of focusing on the stock's price, spend more time staying updated on the company and industry news. It's more valuable than checking stock prices multiple times a day. Don't sell a stock just because its price moves up or down. After thorough analysis, consider selling if you made a mistake in your original purchase. The company's fundamentals have deteriorated. The stock price exceeds its intrinsic value. You found a better investment opportunity. The stock occupies too large a portion of your portfolio. Important lessons for stock market investors. There are a few key principles to keep in mind when navigating the stock market. 1. The market follows predictable patterns because human behavior remains unchanged. Speculation has existed since ancient times, and what happens today in the stock market has happened before and will continue to repeat itself. Emotions like fear and greed drive market behavior, which is why patterns and trends reappear on charts. 2. Patience is key. Don't rush to make predictions or take action before the perfect market condition arises. The right moment is crucial. Buying and selling at the right time is more important than frequent trading. Those who feel the need to trade all the time often miss crucial factors. Trading should be based on a solid, objective reason, not impulsiveness. 3. Do the right thing consistently. When you see a dangerous signal, don't argue with it, avoid it. A great trader once told me, "If I see a train coming at 60 miles per hour on the tracks, I don't stand still. I get off the tracks. After the train passes, I can always get back on." This advice highlights the importance of avoiding mistakes and staying smart in the market. Developing a thoughtful approach to trading. I've learned that successful trading isn't about quick moves or mastering techniques. It's about careful research and clear, logical thinking. Rely on research, not hasty actions, and you'll be able to create your own path to success. Additionally, it's inevitable that mistakes will happen in trading. If you make reckless trades, you'll pay the price. The market is always right, and aligning yourself with it is the wisest choice. My theory is that behind every major market trend, there is an overwhelming force driving it. Understanding this force is enough. Excessive focus on the details behind price fluctuations often doesn't lead to better outcomes. The real cost of trading: learning from losses. Losses in trading are inevitable, but they're not the real problem. The true danger lies in failing to learn from those losses. Regardless of how experienced you are, mistakes and losses are always part of the game because speculation is never 100% safe. Experience, in essence, is a collection of painful and unforgettable lessons. If you don't feel the pain of a loss, you won't remember it or learn from it. Mistakes happen, but if you don't grow from them, that's the real waste. Trading is a constant battle between logic and emotion. It requires careful planning. I realized early on that the market is not simple. It's designed to deceive most people most of the time. The two primary emotions driving the market are greed and fear, often arising from lack of knowledge. Greed, fear, impatience, ignorance, and baseless hope can lead traders into financial ruin. After a few failures, many investors lose confidence, become discouraged, and walk away from the market, missing out on the potential opportunities it offers. The biggest enemy in trading: yourself. The biggest challenge for any trader is controlling their own emotions. Remember, the market doesn't operate on pure logic or economics. It's driven by human nature, which remains unchanged. Control your trades and manage your finances wisely. Never execute a trade unless you're sure it's financially safe. Inexperienced traders often struggle by taking on too much risk in each position. Everyone wants to buy at the lowest price and sell at the highest price. But it's essential to stay calm, accept reality, and avoid putting hope in unrealistic outcomes. In speculation, there's no place for blind hope, wild guessing, fear, greed, or unstable emotions. Your greatest enemy isn't the market, nor other factors. It's yourself. Volatility can help you make a lot of money, but only if you're patient. I can't stress this enough. Patience is what has allowed me to earn significant returns, not rash decisions or impulsive actions. Patience versus impulsiveness, the key to successful trading. Evaluating the market correctly isn't surprising. I know many people who've made accurate predictions at the right time, but they only started buying or selling when prices were at the peak, meaning they made their profits at the best possible moment. Their experience mirrors mine. In other words, they didn't actually make money by guessing right. The real money is made by being patient, not rushing to act, but waiting for the perfect opportunity. Understanding this concept is one of the hardest lessons to learn. But for stock traders, this is the point at which real success begins. Many traders in Wall Street are not foolish, and they don't act impulsively, but they still end up with losses. The market doesn't beat them, they beat themselves. They may have the intelligence, but they lack the patience needed to succeed. Trading as a serious endeavor, speculation is both a game and a job. It requires continuous effort, dedication, and learning from experience. For me, it's not just about passing time or networking. It's about striving to become one of the best in the stock market. The satisfaction and joy come from mastering this challenging field. Trading is like a sport. A skilled trader must operate just like a professional athlete. They must cultivate healthy habits and maintain peak physical and mental health. To keep your energy levels at their best, both your body and mind need to be in top shape. There's no greater pressure or excitement than what you'll experience in the stock market. Do you agree with this view? Key takeaways. Losses are part of the process, but the failure to learn from them is the real issue. Patience is the key to success, not impulsive actions. Your biggest enemy in trading is not the market, but your own emotions. Successful trading requires continuous effort, discipline, and a focus on both mental and physical well-being.